Welcome back, focused learners. Today, we have a genuinely exciting explainer lined up for you. We're taking a highly volatile clinical stage biotech company, Zymeworks, ticker symbol ZYME, and we are throwing it right into the ultimate valuation gauntlet. As expert investment analysts, our mission today is to stress test this stock using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before we pivot and run it through modern discounted cash flow and quantitative models. We really want to figure out, can the wild, binary promise of biotech breakthroughs actually stand up to the most rigorous investing philosophies on the planet? Let's find out. Here's our roadmap for the gauntlet today. We'll grab a quick snapshot of Zymeworks, run it through our 3 value investing legends, check out the modern DCF valuations, and pull it all together for a final verdict. Okay, first up, the company snapshot. Let's establish our baseline so we know exactly what we're dealing with here. I want you to anchor yourself to this number, $23.14. That's the share price of Zymeworks at the time of our analysis. And what's totally wild is that this stock has been on an absolute tear lately. It's up a massive 89% over the last 52 weeks alone. Now, a run-up like that in tech usually screams sustained growth, but in the biotech sector, it almost always screams that a massive make-or-break event is right around the corner. So let's look under the hood. Zymeworks is sitting at a $1.69 billion market cap. They've got a really healthy cash position, right around $364.7 million. Their crown jewel asset is a drug called zanidatamab, or ZYME, which targets HER2 expressing cancers. But here is the absolute crux of the whole Zymeworks story. They are staring down the barrel of a massive binary FDA decision. They have a PDUFA date set for August 25th, 2026. If the FDA gives them the green light, it unlocks a transformative $250 million milestone payment from their partner. If they get a rejection, well, the company faces an immediate existential crisis. All right, let's subject Zymeworks to the conservative, moat-seeking philosophy of Warren Buffett. Let's run right through his checklist. Does Zymeworks have an economic moat? Surprisingly, yes. The FDA has granted them breakthrough therapy and orphan drug designations, so that's a rock-solid regulatory moat. Do they have manageable debt? Absolutely. They only have about $17 million in debt against nearly $365 million in cash, so they pass that one easily. But then we hit a brick wall. Buffett demands a consistently high return on equity. Zymeworks' ROE is a staggering negative 42%. And what about owner earnings, which we usually approximate using free cash flow? Yeah, they are burning cash, negative free cash flow of $77 million over the last 12 months. Because there are no consistent earnings, calculating an intrinsic value with a margin of safety is basically impossible for Buffett. At its current price, he wouldn't just pass on this, he'd likely demand a price near zero to even entertain the risk. So this is a definitive sell or avoid from the Oracle of Omaha. Next up, we're shifting to the story-driven, growth-oriented lens of Peter Lynch. And honestly, this slide brilliantly illustrates the classic Lynch dilemma. How exactly do we categorize Zymeworks? On one hand, Wall Street is projecting 22% revenue growth over the next 3 years, which makes it look like a classic fast grower. But on the other hand, look at that balance sheet. They have a net cash position of $386.8 million. That's $5.30 per share in pure cash, literally making up nearly a quarter of the stock price. That makes it an incredibly enticing asset play, especially considering management is out there aggressively buying back shares. But here's the catch. Because their earnings per share are negative, we can't even calculate a PEG ratio to see if that growth is fairly priced. But here is the absolute nail in the coffin for Peter Lynch. 92.89%. That is the percentage of this stock owned by institutional investors. Lynch loved finding those under-the-radar hidden gems that Wall Street was completely ignoring. With almost 93% institutional ownership, the smart money has already crowded into this trade. Between the lack of positive earnings, which kills the PEG ratio, and the overwhelmingly high institutional ownership, Lynch would almost certainly categorize this as a hold at best, or more likely a sell, despite that really strong asset play on the balance sheet. So what happens when we apply the uncompromising, rigid math of the father of value investing himself, Benjamin Graham? Graham's whole philosophy really boils down to his defensive investor checklist and his famous intrinsic value formula. You take 22.5, multiply it by the earnings per share, multiply that by the book value per share, and finally, take the square root of the whole thing. It's a formula designed to strictly, mathematically enforce a margin of safety. Now, what's genuinely fascinating here is the mathematical reality we crash into.
Zymeworks currently has an earnings per share of negative $1.36. You literally cannot calculate the square root of a negative number. The math just completely breaks. And honestly, this perfectly proves why traditional value models fall apart when you try to apply them to pre-revenue clinical stage biotechs.
Let's quickly check his defensive checklist just to be thorough. They do pass on adequate size, and their current ratio of 10.82 shows incredibly strong short-term financial health. But they completely fail on earnings stability, they have absolutely no dividend record, and they trade at a massive 10.56 times their book value. And Graham, he hated paying high premiums to book. The bottom line, Benjamin Graham wouldn't touch this volatile stock with a 10-foot pole at any price. All right, since the traditional value metrics just shattered upon impact with this stock, let's pivot. We need forward-looking, modern quantitative models that actually know how to capture binary biotech catalysts. To even begin to understand the DCF here, you have to look at their revenue reality. First quarter 2026 base revenue contracted a terrifying 91% year over year, dropping down to just $2.4 million. Their base royalty stream is, well, practically non-existent right now. But looming on the horizon is that $250 million FDA milestone. This company's entire valuation is essentially a rickety bridge across a valley of low revenue, leading straight toward a massive mountain of milestone cash. So the crucial step is how we build the base case discounted cash flow model. To calculate fair value, we have to forecast that $250 million PDUFA payment, plus another $440 million in future anticipated global milestones, and we discount all of that back to today using a weighted average cost of capital of 10.49%. And here's the thing, if you run a sensitivity table on terminal growth here, it kind of doesn't matter. Why? Because the fair value per share is almost entirely dictated by the probability of that FDA approval. If they get the nod, the DCF justifies the current valuation and then some. If they get rejected, the DCF totally collapses. It's highly binary and speculative. We also applied some alternative multiples to round out the picture. Looking at enterprise value to sales, it sits at roughly 16 times, meaning the market is already pricing in perfection. Price to book is also sitting at a high premium of 10.56, and yet Wall Street analysts, using their own probability-adjusted sum of the parts models, project a massive 69% upside to a consensus price target of $39.23. Make no mistake, the street is betting heavily on that August catalyst. Okay, we've looked through the lenses of history's absolute greatest investors, and we've run the modern financial models. Let's synthesize all these drastically different perspectives into one cohesive final recommendation. Here is the final scorecard from our valuation gauntlet. Warren Buffett screams sell, purely due to the negative free cash flow. Peter Lynch sits at a hold. He's intrigued by the cash assets but repelled by the crowded institutional trade. Benjamin Graham is a hard sell because, as we saw, the stock literally breaks his intrinsic value math. But the modern DCF and Wall Street models, they scream buy, totally captivated by the $250 million upside of that impending FDA catalyst. So what's the real takeaway for you here? Our final synthesis boils down to this. Zymeworks has some incredible strengths, a massive $386 million net cash runway, and a management team that is aggressively buying back shares, showing extreme internal confidence. But the risks are equally stark. They are bleeding $77 million in free cash flow, and their survival is entirely, literally entirely, reliant on that August PDUFA date. At the current price of $23.14, traditional value investors just have to hit the sell button. But for catalyst-driven speculators, that robust cash floor combined with Wall Street's $39 target makes it a deeply intriguing, albeit speculative, buy. Which brings us to the ultimate question for your own portfolio. When you look at a stock like Zymeworks, are you willing to throw away the time-tested safety checklists of Buffett and Graham for the explosive, binary upside of a modern biotech blockbuster? It's a remarkably high-stakes game, and August 2026 is going to reveal exactly who was right. Thank you so much for joining me on this explainer, and as always, keep learning.